Hi there, welcome in. You're watching Lowcountry Money Talk. We're just kicking off our show today. I'm Jessa Jeremiah, joined now by expert Phil Bloyd. He's with Revolutionary Financial Group. It's nice to see you.
It's good to be back again.
Wow. Can I start a show by saying wow?
Things changed a little since the last show, right?
Yeah, you know what? And it's big wow factor because there's so much happening, of course, socially, but we're wondering right now, in lieu of our discussion today on Lowcountry Money Talk, what does what's happening in the world right now mean for us? Lots of folks that are in or entering retirement have questions about their financial security. Sure. So let's talk about this and what are we really looking at with the stock market right now?
Volatility and more volatility. But, we've always talked about being prepared. I mean, if we go back to, our first shows, we were talking about a bull market strategy, a bear market strategy, so on and so forth. And I think part of the market now, the NASDAQ at least, the one index is in a bear territory, meaning it's 20% off its high. Mm-hmm. So that happened pretty quickly. Yeah. But there's a lot of volatility. I also have mentioned in previous shows that, these volatilities show you maybe some weaknesses or some chink in your investment armor. So maybe now is the time to take a look and see maybe where you have some issues.
Yeah, and that is a difficult task right now because what we're looking at each day is highs here, lows there, then lows, then they switch, and so it's really hard to understand what's happening.
Sure.
You explained some things for me here on the break about how there's this sort of teetering, if you will, of the stock market. Share that with our viewers.
Okay, sure. So I've noticed this probably going back even to October or so. There seems to be days where, you'll have a run up in the Dow Industrials, the NASDAQ, they may go up 1.5%, 2%, and everybody's like, oh, great, it's over. They take a break and then the next day it reverses again. But when that happens, I've also noticed there's almost two parts to the market. There's a grouping of commodity-based stocks. We can look at gold miners, silver miners, rails, food companies, things of this, oil companies as well. It seems that when one side of that market spikes up, the other side spikes down, and then vice versa.
Right.
So we have to make sure that we have a diverse portfolio, but we also have to make sure that we're not overly invested in individual equities, because if you're taking income now, it's very confusing if I'm taking income from the growth side of my portfolio, or I have to, in essence, sell equities to get my monthly income. I never want to be in that position. But I am seeing some people that come to visit me that are new, and they're in exactly that position.
Right.
So.
Well, and it is hard to know exactly how to handle it, and you do get stuck in these positions because when we're seeing these fluctuations, we're not really understanding necessarily why that's happening. You use the term fear trading. Yeah. So let's talk a little bit about that. Do clients get stuck in that same mentality?
I mean, still, Jessa, we're like the market's driven by fear and greed. So, you have a war going on overseas, and then the fear kicks in, and it's like, oh my gosh, and this and that. And the feeling would be, I gotta sell and get out of that. But if you've already dropped so quickly, 20% of, maybe that's not the best thing to do at the time. We wanna be more strategic, we wanna be more planning, we wanna be more ahead of things. We don't want the fear in the market to determine what we do. We don't want that, what we would call a knee jerk.
Right. What's interesting about this concept is we know this intellectually, right? We know we're not supposed to sell low and buy high, but it is so counterintuitive to what feels right because we do get so nervous in these volatile markets that it's difficult. Sometimes we need folks like you to get us off the ledge a little bit.
Yeah, absolutely. Well, we'll talk a little bit more in the next segment, but the other thing is when we have a recovery day, then people think, oh, okay, it's back to normal. That's not true either.
Right. I think you said it's a smoke screen, so we'll unpack that more. We've got a ton to talk about here on Lowcountry Money Talk. We hope you'll stick with us on the other side of this break. We'll be right back. Welcome back into Lowcountry Money Talk. We are tackling some tough topics today as we watch market volatility really put us at unease when we're talking about our financial stability. But I've got good news for you who are watching, because Phil Bloyd is here. He is helping us navigate this as we really unroll with all kinds of issues happening overseas, global conflicts. So thanks for sticking with us.
I'm here. We're going to take care of it today.
I like it. So we have you covered. Obviously, a question that comes to mind as we do deal with global conflicts and everything that we're seeing in the news right now is, what is this causing from an economic standpoint?
Sure.
Is this really temporary economic volatility, or are we looking at the long haul here in terms of downturns?
Yeah.
And, you know, we're watching in the news, we're hearing about all these sanctions. We're seeing companies literally pulling out by the day of doing business in Russia.
Right.
All of this plays a role, and we need to know what that means for us.
Sure. Well, the thing we have to realize, some of the companies may have big exposure over there, some of them may not. But if they're losing profits, you know, that's going to affect their stock report, their quarterly report. And, you know, when it comes down to it, we look at the profitability of companies to decide if we want to buy their stock or not, right?
Right.
So we'll have an effect there. You also look at the oil, you know, we had issues with energy before. And I think when all the smoke clears from what's going on over there and the media distracted over there, we still have a lot of economic issues here, and we had them before. We had increasing energy prices, we had supply chain, all that still going on. I think the problem might be, though, is if we see this pattern of energy cost where we're having to pay more for energy, that could lead us into recessionary. A lot of times it does. So, you know, if we just talk about, hey, you know, an average family, and I have all this money to spend right now, they're like, well, I can't buy anything because of supply chain. Well, as we start putting more of our savings and our income into energy prices, then we've got less discretionary funds. So then the consumers stop spending and they hold it back. And when that happens, you know, the companies, maybe they needed 10 employees, they don't need them anymore. And then we could get more into a recessionary thing. So if we have 2 quarters of negative gross domestic product in a row, that's considered a recessionary.
Wow.
And coming into this first quarter of the year, most economists are saying we're about 2% or less. We were 7 in the fourth quarter of last year. So we're going from 7 to 2. And once all this energy prices and all that works its way through the system, maybe the next quarter, the second quarter, we could have some issues there with that working its way through.
Yeah, and you know, long term here, we're really talking about the consumer and how they're handling their money. Let's, you know, dive a little bit deeper on the business side of things. You know, for example, one of the most well-known brands in the world, McDonald's, is on the list of folks who have pulled out of doing business in Russia. So walk us through a little bit about what that looks like for them, how that really causes this spike in prices, and of course, obviously, the lower not only demand for the product, but also the stock prices.
A lot of things. So there's things that come out of that region, like wheat. I think McDonald's probably maybe uses some wheat in their bread and stuff. But I think there's going to be 2 problems there. One, if a company is not doing business in that region, they're not going to have the profits from that region. So that's one problem. The second problem is the producer's price index. This is what companies pay for product to make things or whatever. So if the cost goes up, then that retailer, that restaurant, whatever it may be, they have to pass that price on. So we're looking at lower profits because these companies aren't doing business in that region anymore. And also we're looking at higher costs because of inflation. Inflation just came out the other day at 7.9. So it went from 7.5 to 7.9. And I think it's going to get worse before it gets better. So all these things we have to deal with, and these are going to make these companies that have been profitable, it's going to cause them some issues. So is that stock value going to hold up, you know?
Yeah, and you know what this means for your specific portfolio is something that Phil and his team can help you with. So if you're interested in really diving into your specifics, they do a risk assessment, a portfolio analysis. So for viewers who are watching with assets of $500,000 or more, this might be a good fit for you to just explore. So Phil, we have lots more questions. Lots happening around the globe, and we'll talk a little bit more about that here and how it affects your money. We'll be right back. Welcome back into the show. If you're just tuning in, this is Lowcountry Money Talk, and we're talking, of course, about money. We've been talking a lot about the global economy and how this affects you. Phil Bloyd is here giving us some expert advice and really helping us understand what's happening here. So thank you so much for your time.
No problem.
So we've talked a lot about uncertainty. It's a little bit hard not to talk about that because things are so uncertain right now and all of the fluctuations. I think the best way we can help our viewers here going forward in this show is to spend some time talking a little bit about finding certainty and how they can do that with their income. So let's talk about that. For those who are retired, you know, many people utilizing Social Security. Is this a reliable source for us right now?
Well, yes, the Social Security is reliable. There was just an increase of 5.9%, usually inflationary, you know, so maybe next year may even be more, I don't know. But so we want to make sure that we have, whenever we have a person come in, the first thing that I look to them for is how much income do you need? And where are the sources of the income? Is it pension? Is it Social Security? You know, do we need more from investments? There's where we have an issue now. So if we're taking our income, first we have our pension, then we have our Social Security, then the difference has to come from somewhere. If we're taking it from a growth side of the portfolio right now, because let's say, you know, we thought the bull market would never end in 13 years of a great run, and it's like, well, I'll just take it from there and I'll leave a little bit extra in cash. Well, now we're having a really big fluctuation on that side. So we may want to change that right now. So, and give that growth side some time to heal or recover. So how would we do that? You know, the one thing we might consider is, you know, if I'm not in a position where I have to have a required minimum distribution that's mandatory, maybe I have a little bit too much in my savings or checking. And maybe I was taking income from my stock portfolio. So maybe I stop that part and then I take money from my savings or checking, not to deplete it, but just to buy me a little bit of time. You know, that's one way. Maybe I was going to take Social Security later, so maybe I examine and see if I should go on and take it now instead of taking money out of my stock portfolio, which could be down. That's another way we might want to look at that. I'm not saying go out and do that today. I'm saying examine it, talk to your advisor, your tax accountant, see if it's a good situation for you. But if we cash in assets at a low rate, you know, we've kind of done the deal and it's gone, and I don't like doing that. I keep going back to this bull bear market strategy, but you know, if we have assets that when we have this volatility or fluctuation on the growth side of the market, if we have other items in our portfolio that don't have that as much volatility or they're stable, maybe I want to make sure that I'm taking my income from that side. If I don't have that side, then when we have these upticks in the market, maybe I need to do some adjustments and kind of, you know, people tend to just think, okay, we had a big day on the market today, it's over. That's the wrong way to think. We
pat ourselves on the backs and, you know, celebrate.
That's the time to be very strategic and see what you need to maybe switch out and make some changes. So don't just kick your feet back and relax.
Well, and I think the main point that you're making here, whether, you know, some of these examples make sense for the individuals watching, you know, there's many different examples here, so it is very individualized. But the main point you're making here is you need an actual strategy. And just sitting back and, you know, having a plan in place thinking that's an ongoing plan is not a strategy. Realistically, you need somebody who is taking a look at all of your assets and income, making adjustments as things adjust.
Exactly.
Hey, look, I'm listening. I'm learning something.
I want to follow up on that next time.
Okay.
We can talk more about, do people really have a plan, or do they have a grouping of financial products?
Yes, two very different things, and that's why we have you here, because we need a plan, and really that's going to help, save us money, make us more money, and make sure our money lasts through retirement.
Calm your nerves too.
Hey, that's helpful. We like that. Hey, you know what else we like is we've got a whole nother segment for you coming up after the break, so stick with us here on Lowcountry Money Talk. All right, we are here again on Lowcountry Money Talk, our final segment today. And as you, our viewers, have been joining us, we have really worked through a lot of topics relating to today's financial questions, economy, global conflicts, you name it. We've really pretty much covered it. Phil Bloyd is here to help us sort of put a bow on this episode, wrap up some of our conversations today, and we're grateful for that.
Sure, this is a good one to keep.
It's a good one.
May want to record it.
Yeah, I've been taking notes, so maybe y'all have at home as well. One of the things you said before the break, Phil, is do you have a plan, or do you just have a group of financial products?
Right.
That was a pretty eye-opening question. So I'd love for our viewers, I think we owe it to them to really work through that question.
Sure. Let's do this to our viewers. What I'd like you to do right now is just grab a piece of paper and write down what your financial plan is. Then we'll know. So it's like, okay, if the market's down, I get my funds from here. If the market's up, I get my funds for here. This is what's going to happen if anything happens to me. These are where the funds go. How much can I increase my income? What's my required minimum distribution? Where am I going to take it from? So to our viewers now, the really good way to know if you have a plan or strategy is to take a piece of paper and a pencil and write it down right now. And if you're struggling with it, guess what?
You don't have a plan.
You don't have a plan.
That's the scary part.
And let me tell you, it doesn't matter how much money you have. I've had people come see me that are just loaded with big bucks and people with not so much. And when I ask them, I'm like, tell me your financial strategy and your plans. They struggle. And they're like, well, I got enough money, I don't have to worry about that. If you're running a corporation, do you have a budget? Do you have a plan?
Right.
Do you know how much you spend in expenses? Yes. You are running a corporation. So what happens when the market's good the last 13 years, we don't worry about it so much.
Right.
And it's like we've got all this money, we don't have to worry about it.
And here's the problem, as we were discussing this, is so many advisors and people sort of got just comfortable, right? We've set it on autopilot, to your point. Okay, I put in the numbers in my spreadsheet, I have enough money to live out retirement. But what you're describing here is really, like you said, that's just a group of financial products with sort of an average performance.
Yeah,
and what we want to do is find opportunities to make moves to better our financial picture. So describe some, for instances.
Let's be a little more strategic. So a lot of people, they'll go to their advisor and they're like, I want you to run me an income plan or retirement plan or whatever. And for most people, that consists of just putting some numbers in a program. How, what's your Social Security, what age are you going to take it, what's your pension income, and they'll take your investments and they're going to say, okay, we're going to look at an average rate of return of whatever, and it's going to come out and it's going to say, okay, you run out of money in 95. And it's going to add in inflation, more withdrawals from your IRA, all these different things. And you're like, oh, okay, well, that's good because, I don't plan on being around longer than that anyway. Or, some people actually say, well, you better run that to 100 because they're pretty optimistic.
Okay, and I'm feeling good.
But the problem is, what is the underlying instrument of that plan? Now, I've got a better idea. What if we take a more strategic approach and down markets, up markets, and whatever to maybe enhance things a bit? Because you ever heard the term junk in, junk out, right? So what that plan's really not considering is like, okay, now I'm going to switch my income from the stock side of things because it's down 20% or whatever, and I'm going to take it out of the things that are performing at a lower rate of interest rate of return. That plan's not going to take that into an account. So if we take a more proactive stance, now you've been to the advisor and they're like, oh, it's all going to work its way out. Just hold it.
What'd you say? They might say, turn the TV off and
Turn
go
the
play
TV
golf.
off and go play golf.
That's a strategy.
Yeah, that's a strategy. It'll be okay, No, I mean, now we have updates in the market. Maybe we need to make some adjustments. But now's the time because you are seeing the holes and you're planning now.
Right. So in any case, we need to be making adjustments along the way. And if you didn't get all that, because there was a lot of information in today's episode, the good news is you actually can sit down with Phil and his team and do a risk assessment and a portfolio analysis on your specific financial picture. We've had the information up all show, and it's on screen, so please take advantage of that.
And Rachel will be the one to contact with that. So
There you
be
go.
sure to ask for Rachel.
Ask for Rachel. There you go. That's great. Well, thanks, Phil, for all the expert advice. We appreciate you.
I enjoyed it. Thanks.
We appreciate you. We hope we see you next time on the next episode of Lowcountry Money Talk.